leading with how can we help? And I know that's a bit cliche, especially in early stage. Let me know how I can be helpful, I guess is the line that becomes the meme about it. But for Lead Edge, we actually start by helping. And that's always kind of been our ethos, is opening doors and connecting the dots. And actually, we think the best companies are never raising.
Welcome to Partner Path, a podcast that unpacks the venture capital and growth equity ecosystem from a junior perspective. Young entrepreneurs and investors have already had a massive impact on the industry, having started unicorns and launched billion-dollar funds. We discuss these success stories and more by sharing perspectives and advice from some of the industry's most prominent role models. This podcast expresses our views as of the date published and does not represent the views of and is not endorsed by any company for which we work.
Today we are chatting with Avery Rosin, a partner at Lead Edge Capital. Before joining Lead Edge over a decade ago, Avery worked at an early-stage investment firm in Israel and even sold Cutco knives. At Lead Edge, Avery has sourced or led investments in companies like Duo Security, Zoom, Figs, and Artera. Welcome, Avery.
Thanks so much for having me on.
So let's start with your experience selling Cutco knives. What did you learn from that experience?
Look, it's a lot of sales, right? It's a lot of hard work and organization needed to get your appointments set, get your week set up. But it was a great experience. And I learned a lot about discipline. I had a suit and tie. I had knives in my car, but I drive around and set up these appointments. But really what I learned on selling is about selling value. And it's solving problems and solving pain points for the customer. So I speak to customers about what they like to cook. If it was vegetables, I'd show them, here's the favorite knife for chopping. If it was chickens or turkey, I'd say, here's the best knife for carving. And so being able to tailor it to what was most interesting to them, I think was important and translated certainly into any sort of selling.
How did you gain the confidence? I mean, you were young. It was pre-college to walk up to, sometimes strangers and pitch knives that they probably already had in their kitchen.
There was great training for the program. I really enjoyed it. It wasn't as much strangers as selling towards a network. I think that was probably the key thing to learn, right? How to go from one appointment, generate leads, generate new ideas. Hey, who in your network can I call? Who would be open to buying or at least looking? And for me, I actually never ended up selling those bigger sets. I often sold 3 or 5 knives at a time, tailoring it really to like, here's what I like to cook. Here's the favorite knife. When you buy 3, you get the 4th free, that kind of thing. And so I certainly had folks, there was a couple who never ended up buying anything. That's totally fine. It was a great experience for me to be able to do the demos and learn from that way. But obviously dealing with that, some of the no's, dealing with people who declined meetings, and also the persistence needed to kind of break through and get those appointments set. I think those are great skills to learn. And particularly, like you mentioned, I was pretty young. I was 18 when I did that, and it taught me a lot about business and about selling value.
And you mentioned before on another podcast you were on probably 4 years ago that you'll always be selling things, which I think Will and I can definitely resonate with that today, being in the venture landscape. But what exactly did you mean by that, and how has that translated into your growth career?
Everything has some elements of sales, whether you're in any type of leadership role or you're persuading others or trying to influence others. You're getting others to think like you or learn like you. So I think selling is sort of inherent to so many different types of roles. As it relates to growth equity, though, a lot of it is selling, right? The companies that we are pursuing, they've already seen elements of success. They've seen traction. They're of a certain scale. They're not really solving for that initial product market fit stage. They often have a lot of options of where to take money from. And so being able to differentiate and have a reason why that entrepreneur should want to partner with you over another firm, it's really important, particularly at the growth stage.
Do you think at the growth stage that you would index more towards some of these softer skills or that are more on the qualitative side versus the quantitative modeling side? Because maybe you could argue that those are skills that you could learn and pick up on the job.
I think that's oftentimes why people start in a role as a younger person in a junior role at a growth firm, because typically it is sales. And like myself, having been at my firm for over a decade now, you learn a lot of the more technical elements by doing that, by running diligence and leading processes and things like that. So the role is definitely a mixture. I say it's a mixture of sales and reconnaissance, selling, of getting in front of, hey, this company and here's who we are and here's why we should be spending more time together, but also the detail orientation to get to the bottom of, is this interesting and why? Being able to go into the more technical and the analytical pieces are important, particularly because these companies aren't just pitching a dream or an idea, but they really actually have data that backs up, here's how my performance is going.
Definitely. And you just touched on that, you've been at your firm for just over a decade now, which is awesome. You started there right after graduating from UPenn. And what does it take from someone to go from good to great at a fund? And what do you think really propelled your growth, especially because a lot of these funds in venture and growth, they tend to be pretty hot, top heavy. And sometimes it is 2-year associate programs, or maybe there's not a spot for you at the top.
It's a great question. And I would say finding great companies and doing good deals is the best way to have staying power at any firm. And for myself, I was fortunate to join LeadEdge in the early days and to benefit greatly from the differentiated approach of investing that we have, where we activate limited partners. We have over 700 of them in our sixth fund to add value to companies. And so I love telling that story to entrepreneurs, and my ability to source some great investment opportunities and to get lucky enough to work with very talented entrepreneurs is what ultimately allowed me to grow with LeadEdge as we continue to scale our platform. And so it's interesting also to think back to the very early days of the firm. One of my first initiatives was rebuilding our website, building out our CRM functionality, and a bunch of other sort of process-oriented tasks. And so I think being willing to jump into any project to get it done really helped build trust maybe early on when joining a firm. So I think that's reflecting on my experience. As you described some of these other firms that maybe have partners and how to make an impact, I would honestly just say being dedicated, being hardworking, but certainly finding great investment opportunities would probably be the best signal for having staying power.
Do you have any advice for someone who's trying to break into the industry, or maybe someone who hasn't quite found success yet?
The best way to break in is to do the job. And by that, I mean network with people you do not know well, find ways to add value, jump into new categories of interest, build a point of view on what the trends are that are interesting in that space and that might impact the companies in that space, find exciting and high growth companies and find ways to get in touch with the CEOs to learn more about the business, see if you can be helpful to them. The last step from there is to have a fund behind you to go and invest. And the steps leading up to that are super valuable and important. And so I think if you are to show up at a fund with a point of view on high growth companies and categories that you think are interesting, that's certainly a way to get attention of firms. Certainly my team would be impressed by that, but I would just encourage folks who are thinking about the industry and are excited about it to jump into spaces they're interested in, to network with folks like I'm describing. And then from there, as you build point of views, or I know folks who've even kept fantasy portfolios or picked kind of early stage companies and wrote up little memos about why they've been drawn to them. I think that experience is super valuable both in the doing of it, but then also compounds and allows you to build on that, network with people who think similarly to you, and is a great idea for how to break in.
Yeah, I think that's really helpful, tangible advice as well for our audience.
Great. I think that's a good transition into maybe just walking us through and the audience through LeadEdge's strategy. Ground us in what you focus spending your time on and where you feel like LeadEdge is able to differentiate.
LeadEdge is investing out of our sixth growth fund, which is just under $2 billion. So we are writing checks that are 40 to 50 million on the lowest end of the fund, all the way up to $250 million. And it gives us flexibility to lead minority growth rounds, typically Series C, D, E, and beyond style fundraisers, as well as majority growth rounds, and where a company might be looking for a capital partner to help clean up with existing shareholder base or graduate to a new chapter of company building. We're also quite flexible in our approach of getting on cap tables and have been actually from the early days, where we would pursue secondary opportunities or special situations. We don't have ego about how we get on a cap table, but we like to partner with great companies and management teams and find ways to add value over time. We invest broadly across software, internet, tech-enabled services businesses, focus on the LeadEdge 8 criteria set, which we've spoken about publicly before. It refers to companies that are about $10 million in revenue and above. They grow 25% a year or more. They have high margins. They have recurring revenues. And typically we are investing in companies that meet 5 to 8 of these criteria. So a few criteria are things like capital efficiency and retention, customer diversification, and profitability. So like I said, it's about 5 to 8 of those criteria sets. And from there, we go deeper into engagement with those companies. We do outbound sourcing, and that's been the lifeblood of the firm. The founding partners of our firm all started their role in outbound sourcing. Like I said, that's how I got my start, outbound, chasing down CEOs for us. But we really have a value-added approach with our companies. It really stems from where we've taken our dollars from. we have over 700 LPs in our fund, which is a little bit nutty.
Sounds like a paperwork nightmare. Yeah.
Definitely a lot of efforts to manage this group and to keep them engaged, certainly. But it's been a flywheel that's been building over the last 12 years. And so as we get more great investors in, they pull in their networks, they activate their colleagues, and we tell these folks, don't invest unless you're willing to help our companies.
Have your LPs sourced opportunities for you or any deals that went through?
So our LPs oftentimes might be referring things from their networks. We have great LPs who are also investors themselves, and so they might have earlier stage funds where we've come and follow on in a later round on top of them. That's worked certainly nicely a few times. Where LPs are really, really valuable are in a few different ways. Certainly, and I'll say throughout the life cycle, certainly it's as we're trying to get in front of companies, right? Sometimes we have a company that won't get back to us, right? But we say, hey, this is companies in life sciences software, or they're in retail software, for instance. We have big former CEOs of large pharma companies, large retailers that might write to that CEO and say, hey, I'm an advisor for Lead Edge. It would be great for us to be able to have a conversation. That's really allowed us to break through what we call hard to crack companies. Beyond that, we activate them as we're doing diligence, right? If I'm introducing a potential customer and they come back and say, hey, I really like this, I'm going to demo this, I'm going to procure this, whatever it may be, that's a great signal for us. And beyond that, after we invest in companies, they certainly are supportive, whether that's joining boards more formally, whether that's becoming an advisor or a regular sort of advisor, whether formally or informally, as well as opening networks and activating networks for recruiting, for business development, for partnerships, for board development. So it's really been a very dynamic way for us to add value, and it's really something we focus quite a bit on.
A big part of growth equity in our eyes is pattern recognition. And having been at Lead Edge for over 10 years, obviously you've seen quite a few deals. I don't know if you know off the top of your head how many you've looked at and how many investments that's resulted in. Pattern recognition is really important because growth equity is really oriented in analyzing companies quantitatively, right? Being able to recognize what's a capital efficient way to scale revenue and sales and go to market. What should margins look like for this business model? Being able to compare that against different businesses is really helpful. Turn it back to you and just trying to understand from your perspective, and maybe there are one or two business models you want to focus on, attributes of a company or what different metrics do you look at to really parse out what might be an attractive investment opportunity or an unattractive growth equity investment opportunity?
Probably if I was to drill down into the one sort of biggest, most important metric, it would be related to retention, right? And you have a few different types of retention metrics. You think about gross retention, and that's maybe on a revenue basis, where you're saying, and particularly maybe we can talk about the SaaS business model, right? But if you're able to find a company that maybe starts the year with $100 in revenue, and a year later of that same exact customer base, they end up with $95, $98, very limited gross churn, that really speaks to the mission criticality of the software and or the service that being provided. And so I think gross retention is one of those amazing signals of that, right? Of mission criticality, of stickiness, right? But then I think beyond that, the net retention figure, right? Which would say, hey, that $100, when you include upsell from those customers and the downsell and the churn, does that grow to $120? Does that grow to $130? That can really show a natural virality of these products, or at least the ability to launch new products or attach additional products to this customer. And so I think those are really strong signals of health in a business model, just to speak more specifically to that and some of the metrics you might analyze. Because these companies in a given year, even at scale, you might start with, let's say you're 100 million of ARR. If you are a business that has 130% net dollar retention, you would already expect $30 million of growth to come just from that existing customer base, if you're able to sustain sort of that flywheel and that product attach and those renewals and things. So that's really powerful to sustain growth at scale. So I'd say that's probably for customer health. Taking a step beyond that and some of the patterns that I might look for and some of the investments that I've been able to source or lead for us, I really like finding customer love as a signal for people raving about, hey, this this platform or this service is solving a real problem that I have, or this is making me look like a superhero. And when I think back to the early days of doing diligence on Duo Security, which is an investment I had sourced for us now many years ago, like 9 years ago at this point, those IT providers, those security professionals were saying, hey, I am getting rid of all of these support tickets, the people who were having to get hardware or batteries replaced or their passwords replaced, and all of the pain from that experience and all the extra work we had to do, and just make it very simple to manage, very simple to adopt, and making me look like a superhero. So I've always admired finding when I'm able to do that sort of customer reference work and be able to hear from the users of a platform who are able to say, not only is it solving a problem, but it helps enable me and in my career and my things to my appearance to my colleagues maybe or my superiors. That's a signal I often like to hear as well.
You mentioned earlier that you being able to get onto cap tables, you guys can have flexible deal structures. But have you noticed as the market has compressed a little bit and maybe company metrics aren't looking as good as they did 5 or so years ago, have you had to relax some of the metrics that you had in place or goals for your ideal company profile, just given that you're not seeing as much of that anymore in terms of very high NDR, net dollar retention, as well as gross retention, or 70% year over year metrics in terms of ARR growth?
I think that's actually a great question, particularly in this environment. I was talking about some of the natural virality of some of these software products. And so in the case of seat-based software models that within an organization, let's say whether it's developers or salespeople, as those teams might not have had as much growth the last couple of years, you might not see as much natural expansion. So I think you're totally right to say, hey, is 130 the best benchmark? Like I was mentioning, that would be pretty strong, 130% net dollar retention. Or is it more like 110 or 115% is pretty strong in this environment? I would say maybe probably somewhere in the middle would be strong. You could definitely expect some degradation there. What I would say is gross retention is probably still the biggest signal of the mission criticality. If you have gross retention that's more like 80% or 75% or something like that, that probably shows, hey, I don't need this software. I can find alternatives or maybe I can live without it. And so I would say you'd still expect probably, hopefully pretty strong gross retention or people that aren't turning off the platform. But I would agree with you that maybe net dollar retention, particularly in the last couple of years, as it's not gone as viral or as people have scrutinized budgets a little bit more.
Have you noticed an increase in competition from a decade ago where maybe, Lead Edge was a first mover in this type of growth equity strategy that you're investing in compared to now where at least more so the venture capital, the early stage, I really can't keep up with all the funds that are popping up. I think I hear a new name every day. And it's a little bit slower in growth because typically the funds are larger and it's harder to raise $1 billion+ fund. But how have you seen the competition change over the last decade? And has that led to more creative ways to win deals?
I appreciate that. Look, it's always been a competitive environment. There's been great firms that have kind of been early to the growth equity landscape. I think there certainly have been newer entrants, a decade or two, that have really been formidable. I would say for Lead Edge, look, in the early days, we definitely flew under the radar and people hadn't really heard of us. And I think even today, we're still trying to do a good job of telling our story and some of the companies we've been lucky enough to partner with and how we've supported them. But I think we've always come from this approach of leading with how can we help? And I know that's a bit cliche, especially in early stage. Let me know how I can be helpful, I guess is the line that becomes the meme about it. But for Lead Edge, we actually start by helping. And that's always kind of been our ethos, is opening doors and connecting the dots. And actually, we think the best companies are never raising. And so oftentimes things just come together and it happens fast. And so for us, we just try to get to know talented entrepreneurs, talented teams, start by opening those doors, and then hopefully we'll be able to earn a shot on goal, if you will, to ultimately lead around or participate in a round. And so, yes, definitely has remained competitive. It continues to be so. But because we've kind of focused on a strategy of actually trying to drive value and actually trying to help, we've certainly been more formidable ourselves as we approach new investment opportunities.
Avery, my understanding is that you have a couple areas that you like to focus on within software. One of them being vertical SaaS, another being healthcare, and also cyber as well. You mentioned your investment. Maybe just talk us through your thought on covering multiple sectors. For context, a number of the investors that Laura and I have had on the podcast recently really hone in on one sector. And oftentimes they're earlier stage investors. And so it is really helpful to specialize just on one sector. But as I mentioned earlier, growth equity is really a pattern recognition game in a lot of ways. And so I'm curious to get your thoughts on, what it's like covering multiple sectors and how you weigh focusing on fewer sectors to having a broader scope and maybe being able to touch more companies and evaluate different business models. Walk us through what it's like.
Totally, I appreciate that. I think across our firm, we are a generalist. We focus on software, internet, tech-enabled services, like I mentioned, and those are broad categories. So we've invested in many different verticals or many different categories over the years. I like that particularly because it gives us the flexibility to jump on interesting opportunities that present itself and be creative and aggressive in that way. But part of our flexibility across these different sectors is leveraging the expertise of our LPs. And by having such a diverse group of LPs who have backgrounds in healthcare, for instance, in leading vertical software and payments companies, in cybersecurity businesses, we're able to activate them to get smarter about opportunities, to support these businesses, to support our diligence and things like that. So I think that's really allowed us to be competitive in a wide variety of categories over time. I would say there certainly is a balance of wanting to go deeper into spaces, right? And I think part of that is being able to build out the relevant networks that matter and be able to follow the trends closely. And so we certainly spend time across the firm in many different power lanes, we call them. And those are different categories where we have LPs with expertise, where we have portfolio companies with relevant backgrounds, where we have kind of points of view on the market and why we're drawn to it. And we have let's say over a dozen of those, maybe even 2 dozen that we continue to track. And so I think that gives us the flexibility to kind of run at a lot of different opportunities.
I'd love if you could touch on one particular power lane that you cover and an interesting trend that has you excited for the next 6, 12 months or so.
I appreciate that. Look, we talked a little about some of the healthcare IT, and I've continued to spend time in there. I helped lead our investment in Artera, which used to be called Well Health. It's patient communication for hospitals and health systems, kind of the appointment reminder text message, the whole patient experience of coordinating pre-visit, post-visit, questions they may have and things like that. So I really believe in personalized communication, certainly being applied in healthcare, and I've seen that. But I think beyond communication in healthcare, I also think it's hard to ignore the AI trend in healthcare. I think it's one that's really been getting applied very interestingly, both in medical imaging, surfacing key findings earlier, automating various workflows and painful workflows, the tedious parts of our health system. There's a lot of it coding and documentation, pre-approvals. Somehow there's still tons of faxes going on in healthcare. So it's been very interesting to see. I know it still feels like early days with certain AI adoption, but it's definitely been an interesting area, AI in healthcare, particularly given the data and given some of these discrete workflows. You're already seeing companies making a real impact.
Well, should we shift to maybe some more macro thoughts? We've kind of touched on this earlier, just given the competitive landscape to win deals and really stand out in this crowded market. And I think 2024, we've really started to see some firms winding down or choosing maybe not to raise again, or others announcing smaller funds. We're wondering just at a macro level if you think that this, trend will continue or if we might see a shift as rates improve, hopefully.
The whole point is that differentiation is key in an industry with many funds. And so having a clear right to win or a right to serve is required in an increasingly competitive landscape. I think you're going to see folks focus on generating returns and making sure that it sort of sustains their ability to stay in business, and they might get creative about that. Doing sale processes for some of their portfolio companies, maybe doing secondaries like continuation vehicles or strip sales. I think you'll probably see more of that coming up. But definitely I would say the biggest thing for firms to think about and for firms to have staying power is a differentiated approach. For us, it's really focused on a value-added approach. And I think that's ultimately what would allow you to have staying power. Certainly that combined with, great returns.
Do you believe in the proliferation of some of these digital secondary tools like a CardX or something, and like being able to more easily create a liquid market for private positions? And if so, what do you think the secondary impact will be to venture and growth funds?
Those platforms are awesome, actually. I think it's great to help shareholders and investors find access to companies. The challenge often is around really knowing what's going on at the companies, right? Having the right data about the business, making an informed opinion about buying it. These platforms I think they're pretty active today, certainly, and they've popped up at different eras, right? Where you had really large companies that were such as around Facebook, leading up to Facebook's IPO was another generation of these secondary platforms that allowed people to get exposure to that and sort of at any price you were buying there probably was pretty good. But I would say it is a tricky dynamic. And you saw what happened with Carta X and maybe some of the conflicts related to being both a cap table business as well as creating a secondary platform. Some of these types of transactions can create headaches for companies, and so many businesses might try to be really tight with the processes they allow to run and things like that. And so I really admire these platforms for getting people the opportunity to find liquidity and match buyers and sellers, and I think that's going to certainly continue. But I would say there will still be creative deal making that's needed in the industry. There will still be some of these models that actually already are shareholders who are then buying up, and they have kind of the information rights they need to kind of make that informed decision on what price they want to pay. But I think you have a lot of, just being most candid, seeing big discounts to the rounds from a few years ago. You would think, hey, I'm getting a bargain because it's a big discount, but really, without understanding the performance of the business and the latest on the business, just because you're buying something for 50 or 60% does not actually mean that that's a great price for it today. And so sometimes there's some challenge in executing secondaries successfully.
The information rights are really holding firms back to those that aren't privy to them, obviously.
That's certainly one of the elements.
I mean, in terms of, I kind of think of fundraising in two ways as being, you just have stellar returns and therefore your LPs are going to keep coming back because you're giving them money back. But a lot of funds can fundraise off of a story. And so meaning you're just telling a great strategy, or you have great people around you, an amazing network, and maybe you don't have the returns yet, or maybe your last fund didn't return what you thought it would. But I've seen funds raise great next funds off of the story. Do you think there's a point, whether it's at fund 3, 4, 5, in their journey, that the story starts to fade and it really needs to be returns over the story?
Absolutely. Absolutely. And I think it's probably at that inflection point you're describing. A fund one with a great story, a great strategy, folks will back team and market that you're going after and some of the approach. And oftentimes by the time you would get to fund two, if you have supportive LPs, you're going to get that sort of support. And so you'll be able to get to that. But by the time fund 3 or fund 4 or 5 rolls around, hopefully you are executing on the strategy that you said you were going to be doing. That matters a lot. Actually doing what you say, certainly from a strategy and execution perspective, getting into the types of businesses that you think you're going to be able to get into, and the types of rounds and the types of checks that you're going to be able to write. But then certainly, are you able to generate the types of returns? And look, it's different at growth in earlier stages, right? Early stage funds typically take quite a bit of time to generate liquidity. So you might need a little bit longer even in that cycle. But hopefully you're still executing on a strategy that you communicated. And I know LPs really care about that quite a bit. If there is a change in strategy, like, oh, now we're going to do this, and now we're going to do that, and now we're going to jump into this vertical only. Well, whatever it may be, if there's a lot of movement there, it's harder to underwrite, it's harder to track over a longer period of time, and it's hard to build trust in that way. And firms that have had great staying power have had strategies and stuck to it. There's certainly innovation in their models and additions they might add, but I think doing what you say you're going to do is probably the key to longevity on the fundraising side.
Absolutely. And you've mentioned that LeadEdge has continued to have the same strategy over the years. So clearly something's working. Last topic we wanted to touch on, Avery, was just getting your thoughts on the IPO markets this past week. I've had a couple successful IPOs, including Reddit, which is trading up 50+% and after market hours. Would love to hear your thoughts. Like, do you think that this is going to provide a gate for a lot of other really anticipated IPOs like the Stripes or Databricks of the world? And then maybe if not, what will it take? Or if so, what do you think the impact will be?
It's interesting. Well, it was an exciting week, certainly seeing Astera Labs and Reddit both have strong demand for their IPOs, right? It felt like both of them pretty driven with AI and excitement for the chips and the connectivity that's needed for the high-powered computing or the data licensing in Reddit's case. I think there definitely are a lot of great companies that I think are in the backlog for IPOs. I'm certainly hoping that the coming quarter or two, we will see more of them go out. It'll be great for the ecosystem, certainly generating liquidity back. I think it also will show companies what it takes to be worth 3 billion, 5 billion, 10 billion in the public markets. Some of those bigger names and amazing companies that you mentioned, given their balance sheets, they don't necessarily have to go public. And some of them are finding ways to do other secondaries or employee tenders or things to help with that. But really, that's a milestone, right? That's a fundraising event. That's a branding event of going public. And so there's a lot more scrutiny once you're a public company and the execution that's required from there. And so many companies were cautious about doing that. I am hopeful, though, that certainly we'll get maybe some more software assets to go public. And I think there are some really great companies that are of scale, that are executing well, with great stories to tell. And hopefully, the window will start to open here even more.
And if you think over the last 10 years, the IPO market specifically for software changed pretty dramatically. Stripe and the Databricks or the OpenAIs of the world have kind of set the bar for scale being private companies, right? If you think back 8, 10 years ago, software companies would IPO with 100 million of ARR. Now Databricks has over $1 billion of ARR, and they're still private. And so I'm curious, do you think that the bar will remain higher? Do you think that like this trend of these venture-backed software businesses staying private for longer will continue, or do you think it's actually a more near-term attribute of the closed public markets?
I think it's a very interesting question, and you've certainly seen with the more robustness of the later stage funding markets that companies are able to stay private for longer. And you might even think about some of those high-priced rounds from a few years ago were sort of like private IPOs, right? That was big liquidity events, secondaries included, things like that. And those companies are well funded to go and execute for a number of years. And maybe it takes them time to go get back to that valuation, but they certainly are well capitalized to do that. When you think about going public with, let's say, 100 million of ARR, I think you need to have quite a bit of momentum around that phase, or maybe there's some other bigger trends that are propping up the growth rates and the excitement in the business. Typically, you might want to be worth 2, 3, 5 billion, as you go public. And to be worth that, you probably need to have even a bit more scale. I think you might see the first wave of software companies that will start to go public will be ones that are even 500 to a billion of ARR, and of that scale, and then able to command pretty strong valuations as a result. And then I think that might clear the way for maybe some of them that are 200, 300 million of ARR to be able to go public and have successful IPOs. The scale that you're describing, obviously there were a lot of IPOs that were like that. I just do think you probably want to get to a bit more scale and a bit more predictability before going out in this environment.
Yeah, no, very fair. It means that, the IPO wave might be a little bit larger than people anticipate almost.
Certainly would be interesting. Definitely would be exciting. It's been a while, right?
You're our first quick fire round, so try to answer in a few words, but if you have to elaborate, that's okay. We'll give you a few extra words this time since you're the first one. But do you recommend going straight into growth equity after college?
Absolutely. Incredibly dynamic networking opportunities, business model learning.
Do you need operating experience to be a good investor?
I think operating experience is valuable. I think there's been great investors who built a career without that, and it's a investing is a craft to hone over time. So I think the more investing you're doing, the better off you might be too.
How important is brand power at a growth equity or a venture capital fund?
I think brand is very helpful in early stage VC. Oftentimes hiring and recruiting folks to the early people to join the company matters a lot. But at the growth stage, I think it really matters about the value add and how you're able to help companies, and certainly brand matters, and thinking more about that, absolutely. But I think value add probably matters even the most at growth.
Will the AI bubble pop or is it here to stay?
I think the impact of AI is very real. We're seeing it in a variety of ways already. So I think that part is all here to stay. I think investing in companies at 100, 200 times their revenue can be extremely risky. So there will likely be AI companies that fail or don't live up to their last round valuation or even the capital they've raised. But I do think there will be a lot of AI-driven products and services and businesses in the years to come.
Well, this has been a phenomenal episode. Avery, thank you so much for coming on. Laura and I both learned a lot just through the conversation. So appreciate you taking the time, and yeah, let's wrap it there.
Thanks for having me on. Really appreciate it. Fun to meet you both, and great experience.